The Bank of England held rates as expected, but a surprise 5-4 vote has reignited debate over when cuts might begin. With inflation still sticky, growth fragile, and sterling under pressure, we look at what could tip the balance and whether market expectations are running ahead of reality. Joining us to break it all down is Alex Ridgers, VP and Global Head of the Retail Dealing Desk at StoneX. Welcome back, Alex.
Hi, Joanna.
So let's start with today's headlines. The Bank of England decided not to cut rates. Close vote. Why?
Yes, on the face of it, it's a really easy decision. It's a case of balance. On one side, we've still got inflation running too high. We've got, I think, the headline CPI at 3.4%, core at 3.2%. It's come down slightly, but still too high for the Bank of England to consider cutting, really. Yeah. And then on the flip side, we've still got weak growth. So the thought of raising rates it's not going to happen while GDP is at 1.3%.
When are we expecting a move in interest rates then?
This was the big shock today. We're now predicting a 60% chance of a cut next time in March. I think it's the 19th of March.
Yeah.
So before this meeting, there was only a 20% chance. So not to say that's an unprecedented move, but it's a really rare move to be moving that fast. So the markets gave zero chance of any rate cut today. They just didn't even comprehend it. Yet, as you said, when the vote was released, out of 9 members, 5 voted to remain and 4 were to cut. So when you put it one way, that's down to 1 vote, down to Andrew Bailey, the head. Mm-hmm. Whichever way he swings is whichever way the rates move. So that's has been a bit of a shock to markets. And actually, and in Andrew Bailey's comments afterwards, he did say there's room for further cuts to come this year. So that was sort of another rubber stamp, as it were.
That it might happen next time. Okay, what about anything else? Any other interesting news out today, or did this dominate the headlines?
Well, actually, even before we had the Bank of England decision, we've seen real sterling weakness. Okay. And a real sort of, rally in long-term yields. Short-term yields, yes, so in sterling yields. There's a general lack of confidence in Sir Keir Starmer. And so what we've seen is actually, it's looking at the betting markets, there's over 30% chance that he will leave by April the 1st. Okay. And actually over a 70% chance that he will be out by the end of the year. So what the markets are worried about is they're seeing this, if Starmer does go, this is a move to the left for the Labour Party, for the new incumbent leader. And sort of what that means when public finances are already pushed to the limits, they see that as further spending, so a need for higher rates to balance out sort of the fear of I suppose, failure of the UK economy, really.
So what do you actually think is going to trigger a cut?
Well, this is it. I mean, looking today to see, again, the news about the Labour Party and Sir Keir Starmer, I don't really see that as a major driver of rate cuts. Because on the one side, we've got the fact that actually, if sterling's already weakening, any further cut to the UK interest rate is only going to weaken sterling further. Right. And what that tends to do, weak pound, it imports inflation because everything else, all imports are more expensive. Yeah. But on the flip side of that, I suppose one could argue that actually a cut would boost growth, boost confidence at a time that is needed. But what I see is sort of the main trigger that's really going to say, yes, we're definitely going to go through with this rate cut in March, is a drop in the CPI rate. I just wanted to see it start with a 2 handle, if you see what I mean. We've got, so as I said, we're 3.4%, 3.2% on the main and the core. And it's almost like a mental hurdle. The Bank of England says, we need to get back to 2%, its target rate. Yeah. But in reality, there's a bit of leeway there. If they see a 2 at the start, it's such a big jump, such a big leap from 3.0 to 2.9 in my eyes to say, oh, well, it starts with a 2, it's close enough. And actually, I've been really surprised that further today, the Bank of England have said that they expect to see inflation at 2% by April. Okay. I don't believe it personally, but that's their view, and I'm sure they're more knowledgeable than I am.
You talked about balance earlier, so what's holding up the rates?
Well, actually, January we saw brilliant figures out of the UK. Not a lot of news about it because, again,
well, good news never make the news.
Exactly, no one likes good news. But so when we look at all the January data we had industrial production, which was only the 4th time since COVID that we've had a figure that high. And actually, ignoring COVID, the 4th highest figure since 2016. Okay. And actually, manufacturing production, we've only had three values that were higher since COVID, and again, most since 2016, apart from those. Then we had retail sales. They were great. They were up 2.5% in December against 1.1%. and the construction sort of purchasing managers index, which is the idea that they asked people in the construction industry, senior managers, what their outlook is. Are they positive, negative? October and November's values were about the worst on record. They were really terrible. But we've seen a almost 5% rise since then, from I think like 40 down to 46. So we're starting to see a sort of bit of a almost turning the corner for the UK economy, as it were, that could be actually positive and suggest that we're not going to see cuts as quick as we thought.
So then when can we see some actual key data that can turn the tide?
There are two key points, and they're actually really interesting days. One day is, are we going to hold? So on the 12th, we've got UK GDP coming out, but also beyond that, we've got all the positive figures that we had in January. They're coming out again in February. Are we going to keep those trends going? And if we do, it would be a real signal that, hey, maybe we don't need a rate cut.
Yeah.
And then on the flip side, on the 18th of February is consumer price inflation. So again, a figure to the other way, a big drop in that is going to be a big signal to the sort of for rate cuts. So those two key points. I mean, so my personal view is 60%. It's more than 50-50 that we're going to cut next time. But I wouldn't underestimate the resiliency of the Bank of England, to not make changes.
To hold. All right, Alex, thank you so much for all your valuable insight. And thank you to our viewers for watching. For more financial content, don't forget to like and subscribe to our channel.